How dare you?
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
And good morning, everybody. I'm Rich Rosso, Certified Financial Planner, here with Danny Ratliff, Certified Financial Planner for The Real Investment Show, Friday edition. And when Lance is on, the market plummets. When we're on, futures are up. Just take that with a grain of salt. Brent says
it's all bull here on Friday, right?
Took something about Brent's taking some stuff personally this morning. He says that Lance and I are sort of rivaling each other for curmudgeon of the year or something. I still think he beats me by a nose, but I might catch up.
I don't know. You're getting there, buddy.
Thank you. Lance, you're a great influence on me. Thank you. I love you, buddy.
It's just an honor to be nominated.
It certainly is.
Yes.
Yeah, I'm growing the hump on my back as we speak. So obviously futures are up today. You would expect that after, well, I don't think bloodbath is too bombastic for yesterday, but it just shows you when you come out of uncharted territory where we never had a health crisis lead to a financial devastation, the kind of moves, I actually think it was a good thing. And I think it resets or recalibrates retail investor expectations. Don't you, Danny? I mean, I think it starts to get people to focus on, wait a minute, maybe the economy isn't as good as we think. Maybe there is a second wave. Maybe it will take much longer to recover. These are all sentiments that the Fed has provided, Mr. Powell, and I think he was on target. President Trump got on him pretty hard that he was not being optimistic. Well, I just think Mr. Powell was being
realistic to some extent.
The word. No, I think that's the word. So I think as we jump from the fantasy to reality trades, and if you want fantasy trades, you go to Robinhood, which the app absolutely will work the opposite of the story of Robinhood. Robinhood used to take from the rich and give to the poor. The Robinhood app is going to wind up giving to the rich and stealing from the poor. I think because of the fact that people are going to get too riled up by these big moves, but have to realize they are not based on reality. It's an estimate. Don't you think so?
Absolutely. And I also think we have to take in context the manner of how things are happening as well. Last week, Robinhood investors looked great, but it was all on speculation. This week, you don't hear a whole lot out of Robinhood. And
more Friar Tuck.
Yeah, a whole lot of Friar Tuck. But so Robinhood investors got crushed because we saw the market trend a completely different direction and very, very quickly, might I add. And so you have to think, when you think about what Jerome Powell mentioned yesterday, no rate cuts until 2022, no rate hikes.
No rate hikes.
Yes.
Until 2022. And that's pretty, he's
typically more optimistic too, though, right?
Yeah, no, he really is. And I also think that he's talking about something we've been talking about, Danny, structural underemployment as companies reshuffle regarding how much in human resources they really need for whatever level of demand we're going to face. Now, obviously, certain businesses are going to have incredible demand. Certain businesses are going to work at a low hum of demand for years and will wind up not needing people as much as they thought. Now that the PPP, all this stuff is draining down. You also have to remember that $300 billion in IRS stimulus checks were cashed by early May. And then the $600 per week in unemployment benefits, the extra, that was roughly 30 million Americans. That's set to stop at the end of July. So unless there's going to be talk of another stimulus package, and I know there's been some rumblings on that. I tell you, you give yourself 3 or 4 days on the market moving like this, and the market is going to demand more juice. That's just how the market operates. It usually winds up getting it, so I don't know where we would go this time.
I would have suspected if we saw today down and maybe even, maybe Monday, but I would think that over the weekend you'd start seeing people start to rush to pull something together.
Yeah, it's amazing how the market just does the market drives everything. So people will say, well, only 50% of the economy is invested in the market, and that's true. And it creates this wealth bifurcation. People that don't invest in the market, they pretty much live on income, and then people that live on capital gains. But I will tell you, unfortunately, most of the population gets sucked into a bad market because, hey, if your stock price is not doing well, you're going to do some things as a CEO, and you're going to find ways to cut. I know I'm going to cut my marketing budget, but I'm also going to find a way to let more people go. Or I'm going to go with the shared sacrifice sort of conversation with you and cut your pay, even if I do need you. So stock prices have become one of the most important, or not the most important barometer of how people operate, because corporations, as you know, work very short term, right?
Well, they
quarter
do.
to quarter. Guidance. Barry Diller actually used one of those bad words on CNBC to describe what he thought about forward guidance.
That you can't use on here today.
I don't think so.
So
I could use fudge.
Talking about CEOs and some of the things that they're doing, I talked to a client yesterday, and we were just having a conversation on how's business. He said, business is actually picking up. We're moving in different markets that we haven't been. I said, well, you guys got pay cuts. What's the word on that? Is that going to come back? He said, that's actually a really contentious thing right now. So, well, tell me about it. He said, well, instead of giving the salary back, the company has said, look, there's an easier way for us to do this. We're going to go hire everybody away from our competitors and give them salaries, pay them more to get them over, and then hope with the additional sales that we'll be able to bring everybody's back up much quicker, and it's sustainable. And so you're seeing some of those things, those underlying moves that we've thought would happen, whereas, oh, well, it's going to, as soon as things come back, we're going to give you your pay raise or get you back to where you were. And that is just not happening yet. And, that's the only person I've spoke to who said, who was optimistic about things. And I think, look, we're optimistic about things in the future, but right now you paint a picture of what's actually happening, and there are still a lot of concerns out there.
The market is pricing in third quarter is going to be a big recovery.
Yeah.
I mean, listen, you guys out there, your guess is as good as ours. We've never been here before. I can't say this time is different. I can't show you some historical precedent for it. So I hope that is true, and I hope the market is estimating it properly. Hey, we get back. We got a lot of stuff to talk to you about here on The Real Investment Show. 700 KSEV, the voice of Texas.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Everybody get up!
I will have to apologize to the audience because the market's already begging for more stimulus. That's how I know there's a quick link up on CNBC.com that says, more stimulus? Please. I should actually put more stimulus, please. Just from one day.
Can we make a hashtag? You can
I think
tweet
you
it.
can. I think you can.
Please, sir, may I have another?
Please, sir, may I have more? S&P 500 is up 1.93%, 57 points, 3057, sitting on that all-critical 200-day moving average. We have to see where we go from there. Dow futures up 556 points. So you will see some rotation back into the economic recovery trade today. It's going to be very interesting to see what bonds do today, if bonds are going to buy this rally. Overall, I will tell you, do not forsake your bonds, okay? Rates can only go so far since we're so used to and addicted to low rates to maintain our lifestyles. Rates can only go so far before the Fed's going to come in and purchase along the yield curve. We already heard Powell say 2022, rates will be pretty much at zero, and that could be longer. Okay, that is not a function, by the way, of a healthy economy. That is the function of a broken economy, even though it's recovering. Because what we have found out since the financial crisis is when the patient recovers, the patient doesn't really recover to the point where they're able to go out there and maintain and do the things they used to do. They are still not fully healed and need this Fed drug overall in their veins at all times. So the Fed and low rates, Danny, they're going to be with us for a very long time. And I have no idea the kind of strange moves in the market or misallocation of capital we are going to see over the next decade.
Yeah, there's no doubt about it. And, for those of you out there think that this is just the coronavirus that's causing all these issues, look, you don't have issues in an economy. Things aren't rocking and rolling when you have 32 rate cuts amongst developed countries last year in 2019.
Yes, well, think about it. We supposedly have this best global economy ever.
There's no way.
But
then why are you cutting rates?
Absolutely. So something is broken structurally, okay? And the Fed is the one that's providing the drug or the temporary Band-Aid to fix it. We just can't figure out how to actually heal the patient, but we can medicate the patient. So to your point, Danny, yet last year, that would not have happened.
No.
If this was such a great economy based on how we measure metrics or how we create data, we should have been raising rates all throughout last year.
We should have. We should have had people who were putting funds aside. You should have been preparing for things like this. And unfortunately, we're living paycheck to paycheck. And, the Fed and the government does the same thing. So instead of saying, let's pay down that credit card, they go get another one. And then they rack up all the debt on that one. Then they go get another credit card. So at some point, we're taking so much from the future that you're going to see such slower growth in some ways. I do think there's, like we were mentioning, there's lots of opportunity out there. I think we are very optimistic for that aspect of things. And, mentioning third quarter, we're going to see some, I think that any number is going to be better than what we saw in the second quarter. So
absolutely.
Maybe markets take that as a positive, and even if it's not that great, it's going to be better. So everybody says, we're moving in the right direction. But when you shut a global economy completely down almost, of course you're going to have better numbers. It just makes sense. So, one thing I keep noticing, Rich, and you and I were talking about this a bit earlier, just the headlines from yesterday and today amongst professionals in the markets who were saying, I've taken some pictures when I'm watching CNBC or something, and you get some of the talking heads on, and they're talking about how great things are.
Go back to pull those back up again.
And you're like, what happened here? You kind of flip flopped on this completely in a matter of a day. And so now some of these guys are coming out saying, well, it's not over yet. There's going to be some issues. And so, you talk about trying to control and contain your emotions. It is next to impossible to do so when you're listening to the television, when you're looking on any of these sites. And look, there's going to be lots of contradicting information, but when you have somebody from day in and day out, changing the story. And I think that in markets, you do have to be flexible. You do have to change the narrative as the narrative changes. We've had to change some of the things that we believed and thought, even if we thought, wow, this doesn't make sense. But
think about this Robinhood effect in opposite land. All right, when I'm stealing from the poor and giving to the rich. Hertz just came out with an article. There was an article on MarketWatch yesterday that Hertz says, well, since our stock price is doing so well, let's issue more stock, even though we're going bankrupt.
Yeah.
Okay, so let's bring all the suckers in and let them trade it. We're not even hiding this stuff anymore. I mean, if you want to be stupid, do it. Okay, but if you've made money, if you've been trading, and I'm not talking about investing, but if you've been speculating in these airline stocks or wherever you're going, and you didn't take profits or sell, you didn't do the right thing. You just didn't. Think about price gains and earnings growth. When you look at the S&P 500, 6 companies have ruled the world for the S&P 500, right? Right, the FANG stocks and so forth, right? Facebook, Amazon, Apple, Netflix, blah, blah, Microsoft, right? So you have to keep in mind that as we add on more debt, we are becoming Japan light. Japan was at 120% of GDP, right? And there's a great book out there, This Time It's Different, and that was Rogoff and Reinhardt, about how debt over time acts like a weight on GDP growth. Listen, we have now examples of this over time, that there is no way you're getting back to a 3% average growth for GDP. Matter of fact, there's so much talk of that, the fact people are just giving up on it and saying, hey, we got to measure GDP differently. We've seen some countries go, it's based on happiness, how many bike miles I can ride every day, whatever I want to do, how many cups of coffee are we drinking as a society to measure GDP. We're desperate to find a way to measure GDP because economic growth is not going to be where it is with the level of debt that hangs over you. Think about walking down the street with a 1,000-pound plate on your back. You might walk a little bit, but you're not going to be, running this marathon. This is where we're going to be for a while. And the more that weight pulls us down, the more we become like the rest of the world. And this has been something that Jeffrey Gundlach's talked about. And he's also been preaching. Jeffrey Gundlach's a great money manager, but he's talking about the breakup of monopolies. We have not seen this happen. For some reason, all the monopoly laws have been discarded. Google, Brent Clanton wants to put a hat company out there. Because, we're not going to say why. His head will burn.
Sounds like a cover-up to me.
Yeah, okay.
I'll be your business partner.
Yeah.
How dare you? So Google gets pissed. So, you're up there on your Google search. Mm-hmm. Brent's hats. Great business. You piss off Google. Go ahead and do it, Brent.
It's easy to do.
Yeah, you do it every day.
Yeah.
Go ahead and piss them off. Mm-hmm. They take you off their search engine because they can.
Yeah.
Your business dies because where are you going?
Well, I have to go to them hat in hand.
I really did walk into that, didn't I?
Yeah,
but what
did.
I'm saying is when companies like this have such power, something is wrong.
Well, you talk about how we measure GDP.
Yeah.
And the confusion. And I think we've brought that on ourselves because of the contorted and convoluted way that we've been accounting for all that over the years. The CPI index is a joke.
Oh, absolutely. I mean, if you look at how inflation is measured,
right,
in some form, it's ridiculous. Okay, it's interesting. Okay, well, the CPI, was down. We are in a deflationary process. Well, if the supply chain is disrupted, we have a wonderful client. She owns bike shops all over town, right? Bikes have become, this is a business that has actually done well, right? And she works very hard, her and her husband, on doing this. And the thing is, the supply issues, right? So also, she had mentioned to me that the price of bikes are going up, right? Because the demand for bikes, but also supply chain. There's inflation out there at a time when I'm not getting wage growth, or perhaps I've taken a pay cut. Not only that, how damaged am I? And there was a great piece out from Alicia Munsell on the blog yesterday, retirement blog, one of the biggest retirement blogs out there, about the damage of using 401ks to pay for your daily expenses,
for your emergency
and how
funds.
far behind people are going to be. We have just magnified the retirement savings crisis dramatically. So some very tough decisions in your household are going to need to be made. We want to be your partners to help you do it. That's why we're doing something called Candid Coffee. What's brewing in your finances? So tomorrow, Danny and I in our fuzzy robes, we are going to be doing a go-to meeting from 8 to 9. You can register at Real Investment Advice. Send us questions at Real Investment Advice. We want to just have a discussion with you. We want to help you prepare for battle. We want to get down into what you're doing, questions you have. We've gotten a lot of great questions so far. Smart audience. Thank you. Smart readers. We're planning to do this again. We're doing this tomorrow from 8 to 9, and then you can get on with your day. You just log in. Very easy to do. You might hear dogs barking, kids screaming, wives yelling.
Probably a little bit of both.
Just deal
or
with
all
it.
three.
Yep.
At least in my house.
At least at Danny's. I have the dogs. Because everybody is an enemy. When Chihuahuas are involved, forget it. I don't know what it is for Yorkies and Sophie, Brent, but if the same people every day, we see these people every day. We see Mr. Mail person every day. We see Mr. UPS person every day, but it's time to protect the world. Okay? You're going to hear that, but please tune in with us tomorrow. Sit down, have your cup of coffee. You're going to learn a lot. Even if you don't ask questions, you're going to learn a lot from the questions we received and the information that Danny and I are preparing for you at Candid Coffee. And it's also preparing us in case this whole thing doesn't work to be baristas. So we're working on our second careers as this as well. Hey, we get back. We got a lot to talk about at 700 KACV, the voice of Texas.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
I want to be the very best, like no one ever was. Catch them is my real test.
And welcome back. You know, just a thought. There's a very fine line between trading and investing. And in some days, I will admit to you, they bleed over. Because of the fact that right now, stocks are always considered more of a commodity to buy and sell every day. So it's okay if you say, for example, you do a financial plan, you know what your rate of return is needed to hit your goals, you have long-term money that's risk managed. But you know what? As humans, and I will tell you, a lot of retail investors are very smart. They do a lot of reading. They do a lot of research. I'll give you all a lot of credit. But if you want to trade part of an account, like say you say, hey, I set up an account here. You know what? It's not all vegetables. I did my plan. I have my emergency reserve, right? I got my financial vulnerability cushion together. I'm doing all the right things. But you know, I've got $10,000, I've got $5,000, and I want to trade. I want to learn and trade and make my own. There is absolutely nothing wrong with that. It could be the best education you've ever received because you're going to search information, you're going to get to learn about yourself. So there's nothing wrong with having your vegetables and your chocolate. It's when you put them all into the same pot, you get messed up. Although it does sound good. Chocolate-covered broccoli does not sound bad.
Fried.
Yeah, and fried.
Yes.
Listen, next year, rodeo, we see this, we're coming back at you.
Trademarking it
You're
now.
trademarking the RIA broccoli, whatever.
Mm-hmm.
So there's nothing wrong. You know, the industry is constantly, the financial industry, telling you all the stuff you're doing wrong, yet they do it. Okay? It's not wrong if you're able to put rules around it, take losses, take profits, and you look at it differently than you do your investment portfolio. There's nothing wrong with making sells in your investment portfolio. We do it all the time, right, Danny? We rebalance. If there are positions that fundamentally that look overdone, we will sell it. But you know what? We're probably not going to speculate. And if we do speculate at RIA, we got very, very, very tight reins around it. Part of it is, Danny, is our fiduciary responsibility, right? Our goal is not here to speculate with you and have all these speculative items in your portfolio that have no balance sheets or no rhyme or reason. It's out of our scope. We won't do it.
It's all based on hope, right? You're not going to see Chesapeake, Hertz, JCPenney. These guys are not going to be in our portfolio.
You're not going to have Hertz in the portfolio, bankrupt company? We're not.
No.
Lance, look at Hertz. Got to put it in the portfolio. I mean, that's crazy. We're not going to do it. But if
why would you?
Oh, stop. Yeah. How dare you? But if you want to trade it, right? If you have this mindset where you can separate and say, hey, I'm going to buy this stock, I'm going to watch it, or I'm going to put a stop limit or stop loss, right? That's where RIA Pro is great. RIA Pro will give you a lot of ideas on different things that you can do. Even then, we're not going to put into companies that, you know, look like junk. But the point is, there are people that have made a lot of money in these airline stocks on the move. There are people who have made a lot of money.
Oh, yeah.
But there are people I know who've made a lot of money in Bitcoin. But guess what they did? Every time they had a profit, they took it.
Took it right out. Yeah.
They
You
had
have to.
no emotion to the position or, oh my gosh, I'm losing money. I'm going to wait for it to come back. It's funny how sometimes we'll apply investment rules to speculative accounts.
Well, I think that you do have to have some type of rules to those
No, but
speculative
I'm saying is, but
accounts.
if I'm like, oh my gosh, now I'm going to play get evenitis.
Oh,
Right,
you
because
can't do
sometimes
that.
like, oh no, now when did this speculative investment now because you're losing money turn into a long-term investment? When did this speculative thing you own that you're just renting turn into long-term? Because if I
Well,
have
it's
a
loss aversion.
yeah, right. So there's an emotional issue, many emotional and cognitive issues you are going to work through as an investor through this period, especially. Don't you think, Danny? Coming out of this in this post-COVID, it's going to test the very nature of who you are as an investor and or speculator.
Well, you look at the behavior and investing in general, it's all very emotional. And so, I'm hearing from a lot of people saying, hey, I'm rocking and rolling right now. We're making so much money trading. And these are guys that have never traded before.
Overconfidence?
Overconfident. And so now,
That is
some
an
of these,
emotional issue.
That's right. Now, some of these same people are saying this week, it's a different story. Just like I bet that many people on Robinhood I suspect they think the same thing.
Absolutely. So you can't just, like on CNBC yesterday, to your point, Danny, or on just TV in general, we went from, oh, things are great. Oh, my gosh. The same pundits that were saying that we're going to recover, we're saying, well, no, something's changing. Wow. And they never get held accountable. But you're going to be accountable if you've traded based on the information they gave you. Oh, or owned an investment that, oh, yeah, no, see, airlines are coming back. Well, it depends on what day you bought.
Hey, today they look great. But if you weren't in them yesterday, you've missed out because they moved overnight.
Mm-hmm. It's funny how the overnight trade has become one of the most successful ways to trade.
Yeah, what were the statistics? We looked at the stats where if you're trading overnight, if you actually sold at markets closed, bought at markets closed, sold at the open, you were up like some astronomical number for the year.
It was like 600% or some weird number.
I don't think it was that high.
But it was but that's what Bespoke came out with, some wild number.
Yeah.
That it didn't work. But it was a crazy number.
But
yeah.
then if you bought on the open and sold at the close, you were down like way worse than what it
than
would
even the market
be.
is. Yeah. So there are going to be a lot of things. There are going to be a lot of writings. There's going to be a lot of analysis of the COVID and post-COVID world and the impact on finances, not just markets, but your household. Think about many small businesses. I think 30 to 40% of small businesses are owned by individuals who are 50 and older. And they put everything they've had into these businesses. And now that in some areas these businesses are closed
Yep.
or demand is greatly reduced, they have no idea what to do. Okay, you have 62, 63-year-old couples and so forth owning little restaurants and doing things. They have no idea now whether to double down on it or, they're lost. I feel horrible because, again, the backbone of who we are is small business. But
right.
a lot of these small businesses are done with people that say, listen, I want to change. I want to do something beneficial. I don't want to be an employee. I don't want to sit in a cubicle. And the thing is, they had very successful businesses that turned overnight and destroyed. And I don't mean overnight, but felt like it.
I know many people in that same boat where you have this great successful business. And some of these people were saying, why would I even invest if I can invest back in the business because it makes so much?
Right.
The problem is that you continuously invest in the growth of the business, which is, that's fantastic, right? That's what you want to do. But there are these extraneous events that we can't control. And so that's why we always advocate to say, hey, you know what? Don't put everything in here. You need to start getting paid from the business now. Take funds out, set up those retirement plans, make sure that you have funds on the other side of the ledger so that you are protected from these types of events. Not only that, but you have a backup. You always want an exit strategy for just about anything you do. We talk about that all the time when we buy stocks. But what about for the business aspect of things? What happens when things go wrong? And that's why we've talked about the financial vulnerability cushion and in addition to your emergency funds. That's why we talk about how do you start diversifying assets, not between asset classes, but between where do you actually put them. And I think that is huge.
If you had to tap I bet a lot of you in this audience didn't, but if you had to tap your retirement accounts, or people who had to maintain their living expenses, that tells you right away they did not have enough in emergency reserves. Okay? And it's not enough to have 6 months. And again, this is something Danny and I have been talking about for months before COVID, that you need money for serious stuff too. And yes, I know, cash is such a horrible thing in the financial services industry, but the goal of the cash is so you wouldn't have to touch your retirement accounts. You wouldn't have to rack up the balances on your credit cards, right? I'm not saying it's easy to do, but there's a hierarchy of how you do things. And if we're always told, Danny, right? Everything you read, everything you see on television, you have to max out your 401k. You have to max it out. You have to. Well, there are certain things you need to do first that we don't talk about. Now I'm finding a lot of these financial pundits, the big ones, they're now talking about it. Well, it is sort of late to talk about it. I mean, now it's a lesson learned. And we have to recover. Now there's going to be a household recovery of getting out of the hole first. And how long is that going to take to get out of the hole? So think about when you think the economy is going to recover right away, you got to think about the hole that's being created by the financial devastation of COVID. Hey, we get back. Ryan Cohen was the retailer who sold Chewy for $3.35 billion. And put all of his money into 2 stocks. What are the right things and the wrong things he did with that move? We'll discuss it when we come back on The Real Investment Show on 700 KCB. The Voice of Texas. Stay tuned.
South of the river, you stop and you hold everything. A band is blowing Dixie, double 4 time. You feel alright when you hear that music ring.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Darling, you got to let me know.
Welcome back to the Real Investment Show. I'm Danny Ratliff, certified financial planner, here with Richard Rosso, CFP. Hopefully everybody's off to a great Friday. So what do you do if you sell a company and you have $3.4 billion? You start your family office? Do you take a vacation? Do you go buy an island?
Listen, guys, I love you, but you'll never hear him from me again.
I'm gone.
I am gone. I'm going to buy myself like this. I'm going to create this whole little fiefdom in Texas somewhere. Maybe a commune.
The Rosso Ranch.
Yeah, it's gonna be.
I can imagine a big wall all the way around
Oh,
it.
yeah. Oh, big.
Yeah.
Very big wall. You're in. You're allowed in.
All right, sweet.
With chihuahuas.
Lots of chihuahuas guarding the wall. So, but, again, imagine, you've got this windfall. What do? And I'm all fairness to Mr. Cohen. I don't know if he's done the formal estate planning. I pray that he has, and he's done.
I would assume he has.
I would assume that part of it.
Yeah.
But I don't know based on him just taking the money and putting it into 2 stocks. What, Apple and Wells Fargo?
And 2 vastly different stocks. Now,
He diversified.
he did a little bit. I mean, he certainly kept it in California, right?
Technically.
He technically did. It's an extreme.
It's a big extreme.
Here's one lesson I got from this, Danny, and then you can add your lessons. But one lesson I've got is a lot of times stocks are not going to get you rich. They're not going to make you rich. You're going to create a business. You're going to do something that's going to generate wealth. And then what you do with that wealth can build more wealth. Mm-hmm. Right? That's the first lesson you learn. The Chewy's guy, great idea, sells his idea. And now he wants to move it into 2 stocks he believes in. Now, that again, he's, in all fairness, undisclosed how much he placed in these other stocks. So you don't know if he's owning real estate and all that. So the financial industry is all up in arms.
Or how much you put into it.
Yeah, that he's not diversified. But let me explain something to you. Diversification sometimes gets oversold and it doesn't do what it's supposed to do. Am I right? Think about diversification for 1 minute. Yeah, this guy should really diversify because if, say, Wells Fargo went out of business, right, that's the kind of risk you should be avoiding with these kinds of things, right? Because I put half my liquid wealth into Wells Fargo or Apple, and what if something goes wrong with either one of those companies? Then, I'm out of the game. So I could see taking that money and even dividing it up among 20 different companies. I think people today, I met with someone yesterday, they own a separately managed account. There's got to be 400 or 500 stocks in there.
Well,
I'm like,
the
you
problem
own the
with that
S&P
is-
500
yeah.
fund
Go buy
at
an index.
3 times the cost.
Yeah.
So I think the financial industry uses diversification as some sort of pablum for you so that you believe that, oh, you're managing risk, but you may not be overall.
No.
So, in some ways, this guy did diversify. He's got 2 totally different industries, but they are both very cyclical. Although I guess Apple could be considered more, hey, I'm always going to have my phone.
Seems like a staple at this
almost
point.
like a
It's a
staple at
consumer
this
staple.
point.
So there's a new corollary to the old adage: don't put all your eggs in one basket. Don't put all your eggs in 2 baskets. Period.
Yeah, absolutely.
Well, so I agree. You talk about over diversification. I think that's very easy to do, and a lot of big firms, I think, do that. One, it's really confusing because you don't know. There's so many moving parts. You talk about
hard to keep track
just
of,
all the things that are going on. Whereas if you break down a portfolio, a really good portfolio manager is typically going to say, hey, we want 20 or 30 stocks. Maybe you have 40, but you don't just go blanket buy the S&P 500, and that's what we see quite a bit. And so with what he did, I mean, he made no qualms about it. He said, look, I'm trying to, I'm not looking to hit singles here. And he said that he likes to go all in when he finds bets that he has a lot of conviction in. And so
that's probably what made him wealthy to begin with, right? He has the guts to take a risk that many people wouldn't take.
Well, and the way I view this is, look, if I had $3.35 billion, if I put $1 billion into each one of these, one of them's likely going to still be there.
Oh, yeah.
And even if they all went away, I'd still be okay. I could live very well.
I'd be ticked off, but I'm still going to be fine. Yeah.
Yeah, so from that aspect, I completely understand. Now, he also bought, I think Wells Fargo said like $54 a share. It's currently, or it was, it's the time of this article, $31. Apple's been up, so it's more than offset that gain, or at least kept him whole. So, not the end of the world, but not typically the strategy that we want to employ when we're using these funds for our retirement needs. Like, this is a wants thing for him. So this is way different. So don't take investment advice from this, because this is something that, this guy, if he loses it all, he's going to be okay. But if we lose it all when we're going into retirement, and this is everything we have in our 401k, in our funds that we have to rely on, that's a different story.
It is. Now, very interesting about him, and I didn't mean what I said about the real estate because I actually misspoke, but he owns no real estate. He owns just the same house he's been in since 2013. What's good about what he does, he has no hedge funds, no private equity, no venture capital. In other words, what he doesn't understand, he will not invest in. That's what I'm getting from this. I think that's very smart. Because there were people that just got blown up on bank leverage loans because the yields were close to 18%. There was one gentleman that during the COVID, with all the leverage unwound, right? He lost $800,000. He put his entire retirement into these leverage notes that I was reading about and I could barely understand. But he got seduced by the yield, and then his $800,000 was worth close to zero.
When you get seduced by somebody who's the salesman, and that's the other aspect of this, is that Wall Street is consistently trying to conjure up ideas to sell you something.
There's already a COVID ETF. I can't remember what the symbol is.
Is there really?
There's a COVID, companies that'll, I mean, again,
What's in
Wall
it?
Street is a marketing machine.
Yeah.
Well, it's probably got Amazon in it, right? Zoom. Think about it.
Face masks.
What's a great idea? If you have hey, here's our end and start date. Get in, get out, and it's not a forever thing. That has to be actively managed. Most of these are just going to put together a basket and it's going to say, oh, well, it's going to run. Let it run. Mm-hmm. And, it goes to nothing.
But it goes back to your point that Wall Street is primarily a marketing machine. It is not there designed to help you grow wealth, which confounds me as to why everything and all our lives are based on the stock market. Everything we do to build wealth is based on the stock market. And I'm not talking the stock market like I want to go buy Kroger's. I want to go buy Amazon. I want to own good companies. But I'm just going to go on Robinhood, or I'm going to trade all these speculative things, or I'm just going to buy all these index funds, and my world is magically going to be better in 15 years. Well, what if it's what we believe in the next 10 or 15 years that your returns on stocks are closer to 2.5%? Or 3% because of where valuations are today. Believe me, with all this movement in the market and the drop we had and the valuations on stocks are very rich.
Which is amazing.
They were
when you
rich
think
when
about
they
that.
fell. When the stocks were at the bottom, they were still overvalued.
Yeah.
Now, that doesn't mean that you're going to have a big crash. But what it does mean is that you could get very low returns for a decade or so. How are you going to prepare for that? There's no magic to it. It's just hard work, diligence, rules, doing like what Mr. Cohen is doing. He's been driving the same car for years, same house since 2013. He's got billions of dollars, and he's not living above his means.
You know who he reminds me of?
Who?
The millionaire next door.
That's what it is. Exactly.
Remember?
Yes. He walks outside, right? You got to see how the guy dresses, right? It's very...
Yeah.
That, by the way, if you all haven't read that book, people always tout all these Warren Buffett and all these other books, but I will tell you that one, to me, The Millionaire Next Door, was one of the best financial books ever written.
Been out for what, 20, 25 years?
And it still holds.
Yeah.
It still holds. So if you have kids that are just getting out of college, starting a new job, get them that book. It is the best gift you could get them.
What a great college graduation gift.
It is, absolutely. And there's a series of them. But the point is, that first book did a great job of helping you to understand the millionaire mindset and how they do things.
Well, it keeps you from having to keep up with the Joneses as well. And I think that's always a big issue for many is that
they don't care. This group does not care.
That's right. And, you know, I've talked to some people and clients of ours that you would never know they had anything. And they're like, man, I go to the store, the gas station, and the lady there's giving me a Coke, so they don't think I have any money, you know, so the way they dress, drive beat up cars. But they still have nice things and can do what they want. And they have that freedom and flexibility where they're not, encumbered to, material items, and which is great. And so they, a lot of times we see them go towards experiences, and a lot of them still have nice things, but you have to be able to do it. There is a balancing act to it. But I always find that funny when I hear those stories that people are like, man, they got people like trying to give me money when I'm walking down the street. Like, that's just how I dress.
There was one gentleman when I worked at the company I worked at before in the early days. He came in and he had these scruffy old kind of suspenders, and his shirt was all yellow, old shoes, and everybody was like, "Oh my gosh, this poor guy. Does he need? We need to feed him." Yeah, multi-millions.
Yeah,
I'm not saying you need to do that, but what I'm saying is you're not going to live by the Joneses. This Mr. Cohen will probably not move from that house. Trade out his car, and when he does, it'll probably be like a Toyota. I'm not saying that he's not going to enjoy his money, he's going to go on trips and all that, but he's going to respect that money. A lot of these guys that build this kind of wealth, they lose it. They go back to zero, and then they have to rebuild it, and they think that that's some sort of great thing. I mean, it's great that they can do it twice, but why do I want to do that?
It's the MC Hammer syndrome. You never heard that? So MC Hammer got, filthy rich.
Yeah.
Was living well above his means, filed for bankruptcy, and he had to go back to work. He had to start it all, try to rebuild it back up.
So that's the guy I saw at McDonald's.
You can't touch this?
Yeah. Hey, tomorrow, Candid Coffee. What's brewing in your finances? 8 to 9. Sign up at realinvestmentadvice.com. Have a great weekend, everybody. You've been listening to The Real Investment Show. Chris Salcedo next. Stay tuned for his brilliance on this station.
Money, money, money. Must be funny. In a rich man's world. Money, money, money. Always sunny. In a rich man's world. All the things I could do if I had a little money.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.